Credit is something that you will need your whole life, but you don't really learn about it in school, how to get it, how to build it, and that's really where I come in to help. Hey guys, my name is Dan. Welcome back to another video here on the channel for Financial Fridays. For those of you that this may be your first time viewing the channel, my name is Dan. I work at a credit union. I have a degree in finance, and I see a lot of things in the financial industry that many people just don't really know the ins and outs of, and I want to be able to share that with you guys so you don't get essentially caught with your pants down and not really knowing what to do, and instead can become multimillionaires and really understand how money works and the ways to build it and make it work for you. So with that, why is credit important? So credit is something that shows how trustworthy you are. It helps you get lower rates and essentially save money and borrow more money to use on things that you really want. I do have another video here on the channel of why credit is important. So if you want a little bit more deep dive into that, go check out that video. And this video is basically going to be on how to grow your credit and how to build good credit. So what are some key factors with credit and what makes up your score? The parts that make up your score are credit history, credit usage, credit age, total accounts, and the amount of inquiries you have on your credit. So with all those being laid out, how do you grow your credit essentially? Well, there are a few ways. You can do either revolving credit builder loans, or regular loans. All of these do involve you having to technically borrow money. You'll kind of understand when I say like technically borrow money, at least in the revolving credit part as we move along. But yeah, they do involve you borrowing money from some sort of institution and using that to help build that credit. So starting off with revolving credit, this is typically what most people use to build their credit. And these are credit cards. And essentially, you can use it as a debit card, which is fantastic. You only spend what you have and then pay it off every single month with what you do have in your bank accounts. When it comes to credit cards, there's a couple options that you can use. We're not going to dive super deep into the ins and outs of how credit cards work, what one should you go with, and things like that. But there are a couple different types. The first ones are starter cards. You can get these at credit unions, your bank, pretty much any local place that you can get credit cards from, as well as some of the bigger banks. And they are the starter cards where you would essentially give the bank $500 in cash. They would give you a credit card with a $500 limit where you can use that card, spend up to the $500. Don't do that, but you can spend up to that and then you can pay it off every month. And if you pretend to think that it doesn't exist, they already have that $500 that they can close the card out with and keep that $500 to make sure that they aren't losing any money on it. That's kind of how starter cards work, just because of the fact that they're geared towards more people that don't really have any credit and don't have any history to show that they are responsible with those funds. So those are probably the best place to start because you can start building that credit history, and most of them, I think they're all supposed to. I know there's a couple that I've heard about that they don't really give you that money back, but after a year, they're supposed to give them the deposit that you gave them initially back to you. I know for me, I did this with a Discover card, and I paid them $300, and after 6 months, they actually gave me that $300 back and then proceeded to up my limit by like 6 times. I believe they upped it to like $1,500, which I had no intentions of using because that was way too much money, especially then for me to really be like, okay, yeah, I can spend this. Most of them are supposed to give you your funds back and turn it to an unsecured card. That's another term for these starter cards, are secured cards, because they're secured with cash. After you go from the starter cards, you can get regular credit cards, which is probably what you see in your parents' wallets or purses. These are the ones where you can have a limit of however much. I've seen some that have limits of $50,000. It's built on completely trust, just because of the fact that you can go out, you can rack that thing up and then file for bankruptcy, and then it's essentially on the bank that they now have that balance. So that's why you have those starter cards, and then you can move into the regular cards, and then you can get ones like the American Express cards or other traveling cards where you earn points and so on and so forth. Maybe we'll cover those in another video, but that's essentially when it comes to revolving credit. You can also see like lines of credit, which are loans that the bank or whatever institution you're using can give you, where you can pull from at certain points in times, and it kind of operates the same as a credit card but slightly different. Moving into loans, the first one we're going to talk about is credit builder loans. What are they and how do they work? At least at the credit union I work at, these are loans typically around $1,000, where you come in and say, hey, I want to do a credit builder loan. And they're like, okay, this is what we can do. We're going to loan you $1,000. That $1,000 is going to sit on hold to where you can't access it or touch it until that loan is paid. We're going to put it in your savings and leave it there. And what you have to do is you have to make payments on that amount until you get it paid off to build that loan. It can be like a 12-month credit builder loan for that $1,000, where you're paying like $100 a month, or like $75 a month, and you slowly pay that off. And then at the end of the term, you get that $1,000 back and a boost to your credit. These are really beneficial because it's a way that you can start putting money away. Of course, you are paying interest on it, so the bank does make money on it. That's what makes these feasible and helps you be able to build that history and reliability with paying those off. And then if you do default on them, they do have that $1,000 that they can just there and then take back. But these are a great option if you're somebody that's like, hey, I'm thinking about maybe going and getting a car, but I don't really want any credit cards or anything like that. So I don't have any credit history, especially if you're like 18, 19 in college, something like that, and you don't want to mess with credit cards, but you want to build your credit history. This would be a great way to do those, just so that you have something to show like, hey, I am responsible. I can build my credit and I can make payments on time of the amounts that they want or even larger. So they are a great way to improve your credit. They're typically more geared towards people that have filed for bankruptcy and have had problems in the past, but they are exceptional options if you're somebody that doesn't want to necessarily have credit cards, but you are wanting to build that credit history so that you can get something in the future and you don't mind paying a little bit of interest on. Lastly, when it comes to ways that you can really grow your credit, we have regular loans. These can be auto loans, personal loans, mortgages, student loans. Usually anything that you hear about somebody saying like, hey, yeah, no, I have a loan on this, that is what a regular loan is. They are the more common ones that people talk about. And most of the ones that you will see are auto and mortgage loans, and then student loans if they are somebody that has gone to school. But auto loans, because cars are insanely expensive, they cost as much as my parents' house when they bought it back in the 90s, which is absurd. But typically, most people don't have $100,000 laying around just to go finance a car on themselves. So a lot of them will take out loans at banks, credit unions, so on and so forth, to pay those off. Or anytime you buy a house, like I said, you don't typically have $500,000 just laying around. So you go to the bank and you mortgage it and get a loan on it. And then, of course, for school, like I said, it's kind of a repeating process here. You borrow that money, you get your education, and you go on about paying it off with that degree. These are also great ways to build your credit because they do show your credit history, they show your payment history, and can increase the total amount of accounts that you have, which makes it look like, hey, yeah, no, he is responsible. He has a lot of accounts. He can definitely know what he or she is doing and make sure that everything is taken care of. Usually these are the ones that you want to come to last after you have built up your credit, because you can get better rates on these loans. Instead of paying like a 12 or 13% on an auto loan, you can get 5, 6, 7% on them if you do have a good credit history. So that is many of the ways to kind of go about building credit from the start to the end. With each and every one of these, this is what makes up your score. Like your payment history, as long as you're paying on time every single month and you're either paying down that balance or paying the loans off, that shows greatly on your credit score. As well as credit usage, that is something that you're going to want to keep at 30% or lower as just kind of like a ballpark estimate. You don't ever want to go over that, because then it shows like, hey man, this guy's getting kind of antsy here. He's using a little too much. I don't know how he's going to pay this off. And it makes it look bad on you just because you may be overextending yourself. So try to keep your credit usage to 30% or lower just to keep that score up, and it shows that you're more responsible. As well as credit age. Credit age is a hard one because it is focused on the average of all of your accounts. So if you have one for 10 years and then you open one right now, and those are the only two that you have, your average credit history or credit age is now 5 years because it averages out those two. So that can affect kind of what happens. But if you open like an account every single year, it kind of lengthens that credit age and can kind of help out there, as well as inquiries. You get an inquiry anytime that you apply for like a regular credit card or regular loan. And the more inquiries that you have, it can cause derogatory marks on your credit history and drop that score down, because then it's like, hey, this guy's kind of applying for a lot of stuff. You might want to keep an eye out. Something doesn't seem right here. That's kind of how the credit bureaus and institutions look at those inquiries. With all this knowledge, you guys, this is a really overview, top level look down at how to build your credit and improve on it. And I'd really like to know what you guys thought about this, how these all can help you build your credit and kind of where to start, as well as like what the key factors on your credit is. So if this is something that interests you, or you found it informative or at least fun to listen to, let me know by leaving a like and a comment down in the comment section down below. And if you're somebody that's new to the channel and really likes the Financial Fridays and maybe some of the other content that I have to offer, hit that subscribe button and ding dong that bell. I'd love to have you stick around and see what other Financial Fridays topics we will cover here in the future. But with that all being said, you guys, my name is Dan, and I will catch you all in the next video. See ya.